So did you hear the latest on the tariffs that were making headlines? So President Trump has proposed a significant tariffs on goods coming from our neighbors, Canada and Mexico, with a blanket 25% tariff on most imports and a 10% tariff on Canadian oil. But just as the markets kind of embrace for an impact, a potential deal with Mexico is actually holding off those tariffs for now on their side. I'm Stephen Brock, the brutally honest loan officer, and today we are breaking down how these tariffs could affect the economy, your wallet, mortgage rates, and the housing market in general, and what's actually happening behind the scenes with it all. So let's start with the basics. These tariffs are not your typical trade dispute. According to Kevin Hassett, the director of the National Economic Council, this is about fighting a drug war, not a trade war. The administration is targeting fentanyl and cocaine crisis that our country is seeing, which took over 100,000 American lives last year. Their stance: if Mexico and Canada don't clamp down on the flow of illegal drugs, they will face the tariffs. Now, Mexico has already responded, promising to deploy 10,000 troops to our southern border to help curb the flow of the drugs. As a result, the tariffs on Mexican goods have actually been suspended for 1 month to allow negotiations to continue. If Mexico follows through on their promise, the tariffs could actually be delayed or canceled altogether. But what about Canada? The situation there is less clear. Canada shares the world's largest unpatrolled border with the U.S. And while the drug numbers coming from Canada aren't as well documented as Mexico's, experts believe much more is flowing in than what actually gets seized. Here's where the things kind of get tricky. Most economists and the media outlets that are out there are sounding the alarm, warning that these tariffs could actually disrupt the U.S. economy. One key area of concern: inflation. If tariffs are imposed, the cost of imported goods will rise, which could push the overall inflation number higher. Higher inflation often leads to higher mortgage rates, as lenders adjust to the increased cost of living and the risk. This could make housing less affordable, particularly for those first-time home buyers out there, and potentially slow down the home sales and price growth that we're seeing. The market reaction today shows that fear right now. Stocks and other risk on assets are down, while bonds are actually climbing and yields have dropped sharply. Investors are worried about slower economic growth and the inflation that these tariffs could actually create. However, some believe this is just another one of Trump's negotiation tactics, and a successful one at that with Mexico. The president has already spoken with both Mexico's president and Canada's prime minister, with more discussions scheduled for later on. If Mexico and Canada can offer satisfactory plans to tackle the drug crisis, these tariffs may never actually go into effect. The takeaway here is this is a fluid story. The tariffs are suspended for now for Mexico, but the situation could change at any moment depending on the outcomes of these negotiations with Canada. For now, the market isn't focusing on the inflation risk. It's more reacting to the potential economic slowdown. But if tariffs are fully imposed, expect higher mortgage rates, reduced home affordability, and slower housing demand for a short period of time. So do you think these tariffs are a smart negotiation tool or a potential economic disaster? I want you to drop your thoughts in the comments below. And if you are interested in more updates like this and mortgage news, check out my other videos, like and subscribe, and I'll see you there.